Okay, so the last chapter in this series we'll be talking about market efficiency. And it's chapter 12. And inside of it, we'll also be talking a little bit about behavioral finance. And don't forget that there's a whole separate course elective in behavioral finance that we offer, I think, every fall. So if you like some of the stuff I touch upon in this behavioral finance section at the end of this chapter, we have a whole class dedicated to behavioral finance as an elective. Okay, so we're all familiar with the term and the concept of efficiency applied to business, where things run close to perfect, or as perfect as you can get them, to make, in the management aspect, to make things more cost effective, to reduce costs, to run things efficiently, not to waste time or resources. And in the stock market area, efficiency is looked upon of how well investors are deciding to buy and sell stocks to make the price of the stock the closest possible to the intrinsic value. So we all know that there is one price the stock should be based on the true value of the company, and that's this intrinsic value, and it's something that we've been in search of all semester, and we're learning techniques in fundamental and technical analysis to help us understand the intrinsic value of a stock. Now, if most of the stocks in the stock market are trading at their intrinsic value, then we've achieved an efficient market. So one of the aspects of efficient market is how quickly or how well they digest new information and it's priced into stocks. And we want to be able to decide between a profitable and unprofitable investment given the current information. So in all the information available to you, you want to utilize it to make a decision to buy or sell that stock, sort of like voting on the supply and demand of the stock, and that's going to make the price of the stock appropriate for its current situation, all the information about the stock made available. So the prices in an efficient market are going to quickly reflect any and all information that's available. So that's basically saying that everyone has common sense and the appropriate skills to digest and understand the information, set an intrinsic value for the stock, and then buy or sell the stock according to where it's currently trading at. Okay, so the key to determination of the stock price is, and therefore the central issue of the efficient market concept is information. So information is the key. Who has it? How effective are they interpreting it? And do they actually make a decision based on it? Because there are a lot of people who get the information but then don't make a decision. Don't buy the stock one way or another. They just may say, okay, that's undervalued or that's overvalued. They don't let anybody else know, and they don't actually trade the stock. So that's, not that part of the information is not going to be factored in unless someone actually trades the stock, or the information is set out and given to other people who will trade the stock. So an analyst may make a recommendation based on his findings and encourage other people to buy or sell the stock. So that'd be another way of affecting the efficient market. So what's the condition for this stock market to be efficient? Well, you have to have a large number of rational, profit-maximizing investors who are actively researching or participating in the market, and no one individual can influence the stock price alone. So if we're talking about large S&P 500 companies, there are millions of people looking at these companies, digesting the data, making purchases back and forth, and it's very difficult for any entity to overly influence the price of stock with their purchases alone. Some of the smaller stocks are different, because the smaller stocks, you could more easily have an investor affect the price of the stock if there's a small amount of shares trading, or a few amount of market makers dealing in the stock. Information has to be widely available and practically free, and generated in some random fashion. So the information is unpredictable, it just comes out as it develops. And in the past, this was a difficult point to prove because information would come out, but it would take a long time before investors could get it. It would have to be printed up in a book, or the analysis would have to be printed up and mailed. Everything was on paper. And it would take a long time to be mailed, written, published. But in today's age of the internet, things can be electronically published within seconds of the press release. And then the analysis can follow up within minutes as well. And the trading action can follow up within minutes. So with the internet, we do find that information is becoming free and widely available to anybody who has access to the internet, which is just about anybody who has access to a brokerage account most likely has access to the internet. And investors react quickly and fully to the new information. So when the new information comes out, investors move quickly. And you could see this happening with, we're in earnings season. An earnings release comes out. If it's better than expected, you could see immediately the next day the stock price goes up right away at the beginning of the trading, or even after hours. So we can see some reflections of these conditions actually being true in the market that we're trading in today. And remember, the United States stock market is considered the most efficient because it has the most participants and the largest amount of stock equity. Some other equity markets, a smaller country, say Hungary, they might not be as efficient because of the limited nature of the stocks in their equity pool, and then also the smaller amount of investors actively trading. And actually there was a study where they looked at the efficiency of the US market and the efficiency of some European markets, and they found that the US market was much more efficient than some of the European markets, and just for those reasons I had just mentioned. Okay, so what are some consequences of an efficient market? Quick price adjustments in response to information as it's released. So you'll see stocks move faster than you could possibly imagine. And I've actually, you see a press release, and then before you can even pull up a quote of the stock, it's changed. So at the same second, or 1 second after the press release is released, the stock price has already moved. So it's almost like a lightning fast changes in the stock prices reflecting the information. And the prices, we would say that the prices reflect all available information, past and present information, and even inside information that's not publicly available is all reflected in the stock price. And I actually have an article I'm going to post on Blackboard from Business Week that talks about, thanks for the stock tip, Mr. Senator, where a senator knew that Medicaid was going to increase the amount that they pay certain healthcare providers. So that information got out, and those stocks jumped, before the announcement was made. And that's inside information, or information that's not widely available, but yet the stock price is already pricing it in because somebody has that information, not maybe everybody, but. And then price changes are independent of one another, and they move in a random fashion, meaning that the new information is independent of the past information. So it's going to, whatever new information is going to come out, it's going to be independent of any past information, and that alone will affect the stock price. Okay. So there are different forms of this efficient market, and people have drafted this EMH, efficient market hypothesis, and they want to take the concept of market efficiency but break it up into 3 different forms to reflect upon the research and the arguments that the market is not efficient. And the truth is, most people understand the market is not 100% efficient. There's efficiency in the marketplace, yes. At certain times the market is more efficient than other times. So because there is really no perfect market, no perfect efficiency, there are different forms of the hypothesis to kind of accommodate different people's perspective. And some people feel so strongly about efficient markets, they believe in a very strong form of it, where the market's very efficient. And some people believe in a more weaker form where the market has some efficiency, but it's not efficient in every situation all the time. So we're going to talk about these 3 different forms. So you get the strong, the semi-strong, and the weak form. And basically, the strong form, all information, public and private, are efficiently priced in the stocks. In the semi-strong form, only publicly available information is priced in. In the weak form, only the market data, which is the past price performance, is factored in. So let's look at each of these a little bit more closely. The weak form is generally the most accepted form of all the forms of the hypothesis. So most people subscribe and believe in the weak form, and that prices reflect all past and volume data. So the stock, what this basically means in the weak form, technical analysis won't work. So technical analysis is about looking at past price and volume. So we had a chapter 16 where we talked about technical analysis, and we were looking at the stock price behavior and the volume behavior of stocks to help us predict where the stock's moving in the future. And the weak form says that that doesn't work, that that's already factored in, priced into the stock prices. You're not going to find any relevance or any support in technical analysis, because that's solely relying on past history of stock prices. So whatever this past history is, it's already have been adjusted for, and it's 100% efficiently priced into stock prices. So in the weak form, fundamental analysis, fundamental securities analysis works, and inside information works. So if those two avenues are okay in the weak form, and you could use fundamental analysis or inside information to find inefficiencies in the marketplace and buy stocks that are undervalued or sell stocks short that are overvalued. So now we have the semi-strong form. And here, prices reflect all publicly available information. And what this means is all the financial statements, balance sheet, income statement, cash flow statement. In the semi-strong form, fundamental analysis is of no use, as well as technical analysis. So investors cannot act on new public information, such as new financial statements being released, to earn above average expected returns. So the semi-strong encompasses the weak form. So technical analysis won't work in the weak form, therefore it won't work in the semi-strong form, because whatever is part of the weak form is added to the additional requirements of the semi-strong form. And in the semi-strong form, the additional requirement is fundamental analysis doesn't work. So if you believe in the semi-strong form, fundamental and technical analysis of securities, stock selection and security analysis, they don't work in the semi-strong. All that information is completely priced into the market. Looking at balance sheets and income statements and doing financial ratio analysis and looking at volume and price data is not going to help you. All that's completely 100% efficiently priced into the marketplace. The only thing that will help you is inside information. So if you know something that is not general knowledge, a company is going to buy another company, the government is going to change their policy, something that's not publicly known, that will still make you money. The only thing that will make you money in above average returns under the semi-strong form. Now in the strong form, prices reflect all information, public and private. So technical, fundamental, and inside information is all completely factored into the strong form. So no groups of investors should be able to earn any abnormal returns above the market based on any public or private information. So this is encompassing all the concepts in the weak and semi-strong form. So this is basically saying you might as well just pick a group of stocks at random and just hope you get lucky, because everything is 100% correctly priced for what the stock is and all its future potential, all its past history and price movement, everything's completely factored in, meaning that you shouldn't analyze stocks at all. If you believe in the strong form, there's no point in doing any stock analysis or any stock picking. Just pick an index, buy that, and that's it. You don't need to really analyze anything. And there's a number of people who believe in this, but the smallest, a minority believe in this. The majority of people believe in the weak form. Another subset, including most academics, believe in the semi-strong form, and then a select few believe in the very strong form. So you could break up the hypothesis in those three levels. Now, evidence of market efficiency using past data, and there's been a lot of research in this area. So the key to any type of evidence-based research is looking at the consistencies of return in excess of risk. Also, length of time on which returns are earned. So those are kind of two fundamental inputs if you're going to research and try to prove or develop some evidence of the market efficiency. Because you should be able to develop some sort of test or strategy to take data and test for efficiency in the marketplace. So economically efficient markets, we would say the assets are priced so that investors cannot exploit any discrepancies or earn better than average profits or returns, and even including transaction costs of commissions and things of that nature. So that's what we call an economically efficient market, and that could be applied to stocks or any other assets or things of that nature. Now, when you look at assets being priced effectively in an efficient market, you can kind of even think of like eBay as sort of an efficient market. So if you wanted to sell something that you feel has value, you could set up an auction on eBay or review previous auctions of the same item on eBay and see what the average auction wound up being. So say you had something like a rare comic book or baseball card or stamp or some kind of collectible item or antique, and you just really weren't sure what it's worth. You know it's worth something. Go to eBay. It's an efficient market. You can kind of see on past auctions what the price settled at. Maybe take an average of the past 5 auctions, and you get a good idea of what the value of it is. I even do that myself if I'm selling an old iPad or some such thing. I'll kind of get an idea what the value is through eBay. This can also be done for the used car market as well and certain other sites. Okay, so let's going back to the weak form. If we're going to test for independence or randomness of stock price changes, if independent, that means that the trends in the price changes do not exist. An overreaction hypothesis in evidence is sort of what we're looking for. We want to see that we're looking to see that there is some sort of reaction that puts the stock price well above or well below where the intrinsic value is. So if we could kind of show that in certain situations, meaning that if we could use fundamental information or inside information and show that this information can get you above average returns by taking advantage of these changes in stock price, and then we could prove that the weak form does work. So the test for profitability of trading rules after brokerage costs, we could use a simple buy and hold example of the stock, and then look at when news is released, because the weak form is saying just technical analysis doesn't work. So we could kind of look at when fundamental information is released or inside information comes of light and see how that affects the overreaction of the price. So we know that if you ever see an IPO come out or a good earnings release, the stock price can move significantly that day. So if there's an unexpected, really positive earnings release, the stock goes up much higher than it should. Right there is sort of evidence of a weak efficiency. Because if it was a strong efficiency, that change, that information would have already been priced into the stock price. But then we see that price drift lower, that reaction, the overreaction gets mitigated over the next couple of trading days. So generally, if a stock pops up really high on an unexpected earnings release, most people will wait a day or two before they buy it on that news. Because if you buy it right away on that news, usually you're buying the overreaction. In the semi-strong form, we want to look at, now remember the semi-strong form is saying that fundamental and technical analysis doesn't work, only inside information. So we want to look at the price behavior surrounding a particular event, something unique, like an inside information opportunity, and then we want to see if any type of residual error is created. So we could do this sort of abnormal return formula where we look at R is the actual return minus the expected return, and any difference between those two would be the abnormal return. And we could sort of accumulate it. So here is just doing another study saying that, let's measure this stock as far as it comes to event or inside information opportunities. Because then if we show that there really isn't a change, that the fundamental and technical is already built in, the stock price doesn't move a great deal to those events, but only really moves for inside or event-related items like an earthquake or a riot or something that's unpredictable, then we could show that the semi-strong form is evident. Some things that we could look for that we would want to see no change is if there's a stock split. So the stock split, if the semi-strong is true, a stock split should have no effect on the stock price. So the announcement should be made. At the time of the announcement, if there's an effect on the stock price, that actually is not fundamental or technical information. That could be inside information. So if someone knows the stock's going to split and they can trade before that's announced, that would be proof that the semi-strong evidence works. Because the idea is, we know that stock splits, when it's announced, stock prices go up because it's technically a confidence of the management in the company of the stock price continuing to move higher. And people like stock splits. They get excited and they want to own stocks that split. So we know that the announcement of a stock split will raise the stock price. But when the stock actually splits, there's really nothing that's going to change other than the stock price gets cut in whatever proportion. So if before the stock split is announced, if the stock price changes, then that's an evidence of inside. Somebody knows that that's going to happen and word has gotten out, and people have traded on it before the public knows. So that would be proof of a semi-strong form saying that inside information of stock splits would work. If any accounting changes are made, a quick reaction, we would expect to see a quick reaction in the change in value. Meaning like the way they're going to look at inventory or measure inventory or how they're going to account for offshore holding companies and things of that nature. So if changes are made, we want to see how that affects the stock price. Now, if the stock price moves before the announcement is made, that's proof of inside information. But once the announcement is made, the stock price should move on the announcement. But if we see that the stock price actually moves before the announcement, that could be another proof that inside information is changing the stock price before the actual information is public. Initial public offerings. Now, when an initial public offering, all the information about the company is supposed to come out in the prospectus. So investors are supposed to have all the information about the IPO, and the IPO price is supposed to reflect that. So on the opening day, if the stock price jumps up significantly, there should be no reason for that if all the information was already previously priced in. And then most important would be any type of announcements or news. If announcements or news come out, they should have an effect on the stock price. If they don't have an effect on the stock price, it means it was priced in earlier. And that could be a result of people, inside information, people knowing, and the information getting out, which is illegal. So there is consequences and jail time and fines if they catch you trading inside information. But yet, it still occurs. So in the semi-strong form, it says that only inside information should create an abnormal higher return, and that any type of fundamental or technical information really is not going to help you. So if you could prove that in any of these cases of this type of information is known previously, stock price moves up a great deal, then the announcements are made later, that would be evidence that inside information truly is the only thing that can get you an abnormal return. And most people believe that that's true. If I know something significant about a company, say a pharmaceutical company is going to get approval from the FDA, and it's going to be announced at 4:30 today, but I know it now because I work in the company or I work for the FDA or whatever, that's a really powerful piece of inside information. So most likely, people who know that are going to let other people know about it, and they're going to trade on the stock. The key thing is the connection to you. So if you're the person with the inside information and you disperse it and someone trades on it, and the SEC goes to investigate, and they can create a link between you and the person who traded the stock, sort of like Martha Stewart and her advisor, her friend who worked for the company, I think it was M. Clone. They could make a connection, then they could get you for insider trading. If it's, say, for example, harder to make that connection, maybe a former student from mine from 10 years ago sends me an email. It would be very hard for the SEC to connect that I know that person. They'd really have to investigate pretty deeply. But I would have to make a significant trade for them to even investigate me, meaning 10,000 shares or more. You're not going to look at 100 shares or 1,000 shares. They look at the really big blocks. So if someone makes a big 10,000 share trade right a day or two before a big announcement or a big piece of news comes out, the SEC is going to look at that because that's obvious you knew something. And then they have to kind of prove your connection to the inside information. And you're really screwed if you're working for the company that you're trading on, because that's the first level of people they catch, you know. And there's been actually a number of big investigations where they've caught people who they discovered their connection to their inside information and were able to send a lot of people to jail or at least heavy fines or suspend their licenses and things like that. So we want to look at the performance of groups who have access to non-public information. And in the past, analysts would actually get information before everybody else. So in the past, analysts would go talk to companies, or they would get the information on what's happening first and then advise their clients and mutual funds and institutional investors to trade before it was announced to the public. But there's this FD Act, the Fair Disclosure Act, the SEC passed, that made that illegal. That if a company is going to make an announcement, they have to tell the analysts as well as the general public at the same time. Because this is very unfair what they're doing. So if you had the money to pay for this information from an analyst, you could have abnormal returns because the general public would find out much later. So they stopped that practice. And that was sort of proof of the strong form. But now that that's illegal, if there is a way, it's harder to test this because now that that's illegal, it's harder to find the groups that have access to non-public information. So, but we know that corporate insiders usually get this information. And if we could find a corporate insider that somehow is funneling this information to somebody, or maybe as an experiment, a researcher, I don't think this would happen because of legal issues, but say a researcher contacted 10 corporate insiders and said, listen, I'm not going to actually trade on this information, but give me some inside information, and I'm going to track the progress of the stock. And if the researcher finds that the stock price does go up before the information is released, that's evidence of the strong form. I'm sorry. That would not be evidence of the strong form. The semi-strong form, right, because I'm moving to the strong form. Let me restate that. So if they had this inside information is known, if the stock price does not change until the information is released, then the strong form is true, meaning that the inside information exists, people know about it, however, the stock is not changing because of it. It's still kind of confusing the way I'm saying that. Let me restate it just for clarity. In the strong form, nothing can help you get abnormal returns. So knowing inside information, you won't see a big change in the stock price when the information is announced, because it's already factored in. Everything is factored in completely. So even though the inside information is more private, it's already built into the stock price, which seems hard to, how is it already built in? It just is. So having this inside information may make you money in the weak form or the semi-strong form, but in the strong form, having inside information would not make you any money because that information is not going to change the stock price after it's announced. And that's why a lot of people don't believe in a strong form, because they see it time and again that certain information is released about a stock and the stock price changes dramatically. So it wasn't factored in, and knowing it beforehand would have given you a leg up. So very few people subscribe that the strong form works because inside information is such a powerful and useful piece of information to know before it's generally publicly known. So to test for it, you would have to have that inside information beforehand and see how the stock price changes before and after it's announced. Now, one thing that the SEC enforces is that insider transactions have to be made publicly reported. So for example, a form of inside information that would have been very useful is if you know that a company is going to sell, the president of the company is going to sell 5 million shares of his stock in the company tomorrow. And you know that and nobody else knows that because maybe he told you to place the order for him. So if you're the administrative assistant to the president and he's going to place an order to sell 5 million shares of the stock, wouldn't you want to place your order to sell the stock before his? So you go in your account and you sell your 5,000 shares at a certain price, and then he's going to sell his 5 million. The stock price is going to go way down. Now, because the SEC knows that this dramatically affects stock price, which is in itself evidence of the semi-strong form, but not evidence of the strong form, because that's inside information that works. In order to cancel that, the SEC said that any insider has to record with us and document with us their intention to buy or sell the stock well before they actually buy or sell it. Maybe 30 days or 60 days. They have to go to the SEC. I intend to sell X amount of shares of stock over the next 60 days. Then the SEC publishes that so investors know. And I'll show you where you can find that in Yahoo Finance at the end of this. And based on that, they don't have an unfair advantage. So they can't sell the stock ahead of people knowing that they're going to sell it. So that actually circumvents that piece of inside information. And there was a study covering the 1975 to 1995 period that found that companies with high incidence of insider buying outperform those companies who've done a large amount of selling. So that's common sense. It just says if the insiders of the company are buying the company stock, they've shown that those companies outperform than companies whose insiders are selling the stock of the company. But it makes sense, right? If I'm working for the company and I have no faith in the company, I'm going to probably want to sell my shares of stock in it if I don't think the company's going anywhere. But on the other hand, if I'm working for the company, I see how great things are going, I see the orders are coming in, the business is expanding, I'm probably going to want to buy more shares of stock. So that's a tool you can use as an investor to kind of see how many shares are being purchased and sold in the company to get an idea of how the people working for the company, how well they feel about it. And I guess we would all agree, I'd rather buy a company that most of the insiders or people working for the company are actually buying the stock as well, rather than selling it. Because they would know first what's happening before anybody else. Actually, okay, so if you go under the Yahoo Finance and you scroll down on the left side, you'll see something that says Insider Transactions. You can click on that and you can get an idea. So for this company, HomeAway, insider purchases, there's been no insider purchases, and there's been 1 million shares of stock sold. And the total insider shares held is 10 million. So 10% of them, 10% of those shares owned have been sold. So that's a really bad sign. I would not want to own this stock. And let's see what happened. And let's see what happened to the stock price. Oh no, I want the chart. Over the last 3 months or so. So we'll do a 3-month. And we see here that this blue line is the stock price, that recently it had a huge fall. So if we go, it was around $32 and it dipped down to 27 or so. So those insiders probably knew that, and the reason that fall happened is because their earnings were not as good as expected. So the insiders probably knew that that was coming up, and they said, let me sell my shares of stock because the investors aren't going to like this when it happens. So isn't that a pretty powerful tool that, even in your stock analysis reports, when you could update them to put that insider transaction information inside the report, saying that if you see more shares being sold than purchased, that could be a concern. If you have a buy recommendation, you would make that a concern. If you see more shares being purchased than sold, you make that as evidence that even the insiders are so confident they're buying the stock. So that's another critical piece that you could add to your investment report to keep me happy. Okay, so you can see that kind of makes sense. That study makes sense. All right. So what does this mean for you, this efficient market? What should you do if the markets are efficient? So that means that you shouldn't look at technical analysis because that's not going to have any value, and you shouldn't look at fundamental analysis because that's not going to have any value either in the semi-strong form. So if you subscribe to the semi-strong form, it would say don't bother looking at financial statements or or technical information. Only inside information can help you, but that's something that's very difficult and rare to get, which means that you're doomed to really only experience average results. So if you believe in this, say, at least the semi-strong form, that means that the best you could do is get average returns. Meaning that I'll just put my money in S&P 500 and live with those average returns, because I know there's no way for me to get above average returns. However, we look at the stock market trading game that we're playing in this class, and we see that plenty of students are making above average returns, in fact, incredibly above average returns. So if you're one of those students making those incredibly above average returns, it should be hard for you to believe in these efficient market hypotheses because you're already proving it's wrong. You're already making a great above average returns by paying a little bit closer attention to the stock market, and you're getting fantastic returns compared to what the market's done since January. So right there, you're living proof that maybe the markets aren't as efficient because I've found inefficiencies and I've actually made money on them. So that's one reason a lot of people don't believe in this efficient market, because so many investors have been able to find inefficiencies and make money on it. Okay, so for professional money managers, it would mean that they can spend a lot less time doing any type of individual securities analysis. They could just formulate a passive approach and hope for the best. So if you do believe the markets are completely efficient, you just maintain a well-diversified portfolio, and you're looking to make a balance and get a desired return for the risk you're willing to take. You manage your tax burden, you manage your costs, and that's the most that you could do as a professional. Is you can't really analyze stocks to look for any inefficiencies, so you just have to make a well-constructed portfolio that minimizes tax and minimizes costs to get an average return. And there's some investing companies that are just completely tailored to this, like Vanguard. It's just indexes, and they're just tailored to low cost and low tax burden and just average returns, and they just believe in an efficient market. And they've done fairly well in these beliefs. And there are many more in mutual fund companies that believe no. My team of analysts can consistently beat the market and get above average returns by exploiting our investigations in the stocks, their fundamental and technical positions. Now, one thing that makes the efficient market hypothesis weaker is that there's a lot of anomalies within the markets. One constant anomaly is that earnings announcements greatly affect the stock prices. So adjustments occur before announcements and after announcements. So if the market was efficient, these earnings announcements should not really cause much of a ripple in stock prices. But we consistently see that, and if you're holding any stocks or you're tracking or following your own group of stocks and you notice a big change in the stock price, so anytime I go to, say, Yahoo Finance and I get the biggest increase, stocks that have the biggest increase today or the biggest decrease of the day, generally when I see the really large increases, I know it's either someone's buying them, a really good piece of news came out, or a really good earnings report came out. Usually those three things explain most of the abnormally high gainers for the day. And on the other side, stocks that are losing a great deal, that's generally an earnings report that disappoints. So this is, if markets were so efficient, we wouldn't see so much turbulence around earnings reports. So there shouldn't be a lag in the release. There shouldn't be any movement before. Another anomaly is the PE ratio. So when analysts look at PE ratios, if everything's efficient, the stock's PE is what the PE should be for the stock. However, when analysts have put together research on low PE stocks, stocks that have PEs lower than the market average, they generally outperform and have higher returns, risk-adjusted, than average or high level PE stocks. And PE is public information. It's known every day. So putting together, taking, say, the S&P 500 and buying the 50 stocks in the S&P 100 that have the lowest PE ratio, that significantly beats the 50 stocks in the S&P 500 that have the highest PE ratio in these previous studies. Although it depends on the study. Some studies will show, a lot of studies are conclusive, some are inconclusive, and it depends specifically on a time period. There are periods of time where the opposite is true. The high PE stocks outperform the low PE stocks. So this can be played around with depending on what time period you're working with. But generally in the past, PE stocks have had a higher return than the low PE stocks have had a higher return than the high PE stocks. So should you just make a portfolio based on PEs alone, or just buy low PE stocks? This could lead to unintentional minimization of your diversification, because generally industries, the whole industry will be affected by low PE. So you may just be concentrating on a couple industries and not be that well diversified if you stick to just buying low PE stocks. But this is something that you could easily test yourself. Find an index or average somewhere, record the PE, you could download this information, I think even from Yahoo, get the PE ratio for each stock, sort it by PE ratio, and buy the 20% of the index that has the lowest PE ratio, and then see how that does over time. And also simultaneously, I'm not saying with your real money in a brokerage account, I'm saying in like a virtual stock market like we're trading on, try one of these strategies out and see if if there's any merit to it. The size effect, which says that smaller firms have higher risk-adjusted returns than larger firms. So don't confuse this with PE. PE has nothing to do with the actual size of the company, but the actual size of the company as measured by, you could measure the size of the company in two aspects: market capitalization, which is stock price times outstanding shares, or sales. Typically, we measure companies by sales. And smaller companies tend to have higher returns than larger companies. And this effect can be discussed through common sense. So the common sense is a smaller company, like say Shake Shack, is going to have higher returns than McDonald's, because Shake Shack can easily double the amount of restaurants they have every year for the next 10 years before they catch up to McDonald's. So the smaller companies thereby have a greater growth potential because they could grow into the industry have much more growth potential than someone who's completely large and established everywhere and there's few growth opportunities. That's sort of the concept. So Chipotle Mexican Grill can have much higher returns and a much higher returning stock price because their growth potential is greater because they don't have restaurants everywhere yet like McDonald's or Burger King or Wendy's. Okay, the January effect. This is an effect where small stocks tend to perform much better in January than the rest of the year. So small stocks tend to have a really good return in January. Of 30% of size premium, half the effect occurs in January. So if you look at the size premium, meaning that we know that small companies do better than large companies, but if you broke down their return for the year, most of their return comes in January. So it would say, if you were going to take effect of this anomaly, you should buy small cap mutual fund or small cap index funds in December and then sell them in February. Because most of the year gain, 30% of the gain for the year will occur in January. if you were. And there are people who, the more people who act on this effect, though, sometimes the more self-fulfilling it gets. If more people are starting to buy in January in anticipation of this increase in stock price, it's going to happen. And then they're going to sell in February when the stock price diminishes. Okay. There is this value line ranking system. So value line ranks stocks from 1 to 5 stars, 5 being the best, and they do about anywhere from around 1,700 stocks. And then they looked at the performance of the different tiers of stocks. So we could say Group 1 had all 5 stars, and their annualized returns were 19%. So by looking at, so this is, value line is ranking stocks based on fundamental analysis. And so the stocks that they rank the highest typically outperform the whole group. So that would be evidence that the market isn't efficient. So this group is using technical analysis to put rankings in stocks, makes them public, and typically the stocks they rank the highest are outperforming the stocks that they rank lower. So if the market was efficient, this wouldn't be possible. And this is stuff that you could look up on the internet, value line ranking system, and it's published quite frequently, and you could get this information yourself and get ideas of stocks that you may want to trade on. Data mining. This is a relatively new anomaly. So can you exploit above average returns by data mining? Which data mining is basically taking large amounts of data and combing through it for some sort of information, pattern or information to help you buy a stock. So you're searching for patterns in securities returns by examining various techniques applied to a very large set of data. And apparently this data mining works. People have been making above average returns and exploiting their ability to use computers that can have very big processors, can access large databases, and this is something that a lot of hedge funds do. And hedge funds are using this data mining with additional mathematics to search for these patterns, and they've been making above average returns. That shouldn't be possible in an efficient market. So the market is efficient. These hedge funds are betting the market's not efficient because they're using data mining to find the inefficiencies that individual investors can't look at the whole market and they can't just digest everything. But with data mining and computers, you can digest everything. And they're using that to leverage better returns. And that's the whole principle behind most hedge funds. Okay, now we're going to switch over to behavioral findings. And this is, my belief is that markets are inefficient because people are inefficient. So I don't believe in the efficient market hypothesis myself. Because if computers made all the trades, the market would be efficient. So if we just took the computers and we put in all the parameters of how to discover intrinsic value, and we let the computers run through all the data and make all the trades, then we would have an efficient market. And then all we would do is invest in that market and get an average return, and that would be the end of the story. No analysis needed, because the computers do everything. However, the stock markets decisions are not run solely by computers. They're run mostly by individuals, and individuals have behaviors that are not logical, are not always consistent, and that's what creates the inefficiency of the market. So people are inefficient. Everybody in this room is inefficient. You waste tons of time and money and water and your inefficient actions all day long. And this is reflected in the stock market. So you have behaviors that are not the norm, are not rational, that can affect you from time to time. So you can be distorted through your decision-making process, can be clouded, your judgment, your perception, your predictions, and how you perceive the environment could be confused and clouded through just your behaviors, your experiences, your emotions, your fears, your anxiety. So this is sort of behavioral finance is a marriage of psychology and finance together to get an idea of what investors do. And here are some behavioral finance big topics. One is loss aversion. And I see this as the most prominent thing, that people have a problem admitting when they're wrong. So for example, you buy a stock and it turns out to be not really a great investment. You'll hold on to that stock a lot longer, hoping that things will turn around, that you'll be proved right. So you don't want to buy a stock, lose money, and then sell it at a loss because now you're wrong and you've made a mistake. So it's much easier to say, okay, I'm not wrong yet. The stock price went down, but it's going to come back up, and I'll be proved right. So investors typically hold on to their losing stocks longer than their stocks that gain. And nearly 50% more likely to sell winning stocks than losers. Peter Lynch had said that investors pick the flowers and leave the weeds in their garden. So you go to your stock garden and you say, okay, this stock went up 10% and this stock went up 20%. I'm going to sell those stocks. Those are cutting the flowers. And now these stocks that have all lost money, have done nothing, the weeds, I'm going to leave them in my portfolio. So what does your garden look after consistently doing this for a while? There's going to be no more flowers and just weeds. And that's a horrible portfolio. So what Peter Lynch suggests is sell the stocks that are weeds. If your stock goes down by 10% or more, sell it and buy another stock. If your stocks are going up, you hold on to them. So Lowe's, Home Depot, Microsoft, Apple, there are all periods where these stocks were flowers for long periods of time. And I know firsthand you should hold on to those flowers, because I've sold flowers to say, wow, the stock went up $10. I made so much money. I'm such a genius. Only to watch it go up several $100s more in the next 15 years. So loss aversion makes you want to hold on to what the stocks that you're losing money on, so you could prove yourself right at a different period in time, but sell the stocks that made money so you could gloat and tell everybody how wonderful you are and how smart you are. So this loss aversion is an emotional connection to stock trading that you need to fight against. You need to not think of not having ego when you trade stocks. If you lost money in a stock, then you lost money in the stock. And Peter Lynch had said that you could be the best mutual fund manager in the world, the most successful mutual fund manager in the world, if you're only right six times out of 10. So if you buy 10 stocks and 6 of them do good and 4 do bad, you are a fantastic mutual fund investor, someone who's going to have abnormal higher returns. Because most mutual fund investors are usually right 5 times, wrong 5 times, or right 4 times, wrong 6 times. So if you could just be right the majority of the time, that would be enough. You don't have to be right all the time, just 60% of the time, and you can make great returns. And remember, for most people, losing money is a much more painful experience than the pleasure of gaining money. So if you make a bet at a casino and you lose money, you're going to be down and upset about that for a while, the whole day, maybe the whole weekend. But if you actually make money, that's pretty great for a little bit, but that wears off faster. So when I win money in a casino, after 6 hours, I've completely forgot about it. It's no big deal. But if I lose money, I'm depressed about it for a whole month myself. So that's why when I deal with stocks, I have to fight against that. Overconfidence is another big problem. And some of you may become overconfident investing in the virtual stock market. So in the virtual stock market, you've done very well. And you're thinking, wow, I've done this virtual stock market. I've made millions. I've made hundreds of thousands of dollars over a few months. I need to use my life savings and start doing this for real. And that's when problems can start to occur. So if you think your ability is above average, or you're greatly superior to everybody else, and you trade on that belief that it's really difficult for you to make a mistake, then you're probably going to lose a lot of money. So if you were just think that you possess skills that are actually above most everybody else, and you become overconfident, you're not going to have that voice in the back of your head questioning, is this the right decision? Is this, are you making a mistake here? Is it time to call quits on this? A well-known study shows that this overconfidence in investors leads to trading more often than other investors, resulting in performance that's below average. So what typically happens is overconfidence leads to bad performance that corrects your overconfidence. So overconfidence is something that you may have for a short period of time because the market will test you and correct you for that overconfidence. And I had a period of overconfidence where It was really just the market doing so well. The market had, in the 90s, had gone up 20% a year for about 5 years in a row. So I had interpreted that as, hey, I am a genius. I can make no mistakes. I'm making, 20% a year on my money. So I must be really, really smart. And then the year 2000 tech bubble burst, and I lost all sorts of money. And I said, wait a minute, I'm supposed to be so smart and educated. How could this possibly happen to me? So I lost some money in the 2000 stock market crash, but that only corrected my overconfidence and then set me up for that perfect market timing that happened in 2007, where I was able to miss the next stock market crash because I'd lived through the first one before and I saw the signs. Basically technical analysis of this is what happens right before a stock market crashes. So I know when a really big crash happens, I kind of see the signs. You get a good 6 months worth of them before it actually crashes. And no, I'm not seeing them right now, so there's no crash in the stock market in the next 6 months, so don't worry. The framing concept, and this is a problem where, you frame a picture, so all the information is just in that frame. So if you look at a picture, it doesn't go outside the frame, it's inside the frame. So framing it can affect your decision because you're narrowing your view of what you see or what you're interpreting. So it's sort of having a closed-minded approach to viewing all the information about a stock. So you're only looking at that one frame, you're not seeing everything else around it. So that's going to affect your decision. So it could also be called narrow framing, where you really, or there's like something associated to it where you're self-preservation of your beliefs, meaning that you only want to read articles that are in agreement to what you think. And you never really want to read the articles that are counter to what you think. So you keep reinforcing your beliefs, and that leads to making bad decisions because you're not well informed. I fell into this trap once or twice where, a stock could do no wrong, and I'm reading all this good analyst reports and just all this good news about the stock, and I really wasn't looking for or looking at the negative side of it, or the people who thought the stock wasn't really the greatest thing, and that sort of created a bad situation. Now, a herding effect can be applied in two situations. If institutional managers can create a herding effect, when the institutional managers say, okay, this is a stock I have to have in my portfolio, and that's when we get that 90 percentile of institutional people owning a stock. So everybody knows about the stock, everybody expects me to own the stock. They're not going to buy my portfolio mutual fund unless I have the stock inside of it. Maybe it's Google, it could be an example of that. And so they all everybody just rushes in and buys the stock because it's expected of them to own it. So the herding effect of institutions. But there could also be a herding effect of individual investors as well, which we'll talk about in a minute. Oh, actually, it's the next thing. So sometimes if the individual investor, they can have a herding mentality too. But what's dangerous with the individual investor is that they're mostly wrong. So the smaller individual investor, when they have a herding mentality, you want to do a move to them. So if all these small investors are buying a particular stock or running into the stock at the end of, pushing it to abnormal heights, you want to sell that. So if you see a significant move in the stock price and you see it's just individual odd lots moving that stock, then you want to be a contrarian and do the opposite of those herders. And that became a whole field of contrarian investing. People have come up with these concepts and been a real proponent in how successful you can be having a contrarian investing approach where you're doing the opposite of what the small investors are doing. Because the idea is the behavior of the small investor is the worst. So the small new investor who's trading in odd lots, they have all the wrong behaviors and financial motivations, and they make all the wrong moves. And I've seen that time and time again. Typically, they sell at the bottom, buy at the top. They make all the wrong mistakes. So you find out what that herd is doing, and you do the opposite, and that's the contrarian approach. So in a lot of cases, it's taking positions that are out of favor than what the general public is viewing. So some conclusions about market efficiency. There is some support for market efficiency, and there's a lot of research that does show at least the weak form and semi-strong form have some definite support that the markets have a level of efficiencies. But there's been many more research that shows a very strong level or strong form of efficiency is not accurate. And that fundamental analysis, inside information, or even technical analysis can help make you above average returns. And some of the strongest evidence is that people have been doing it. There have been managers and stock traders who've been getting above average results by using these techniques. So you would really need to be, if the market is efficient, but not totally efficient, then that would be able to leave some people who can find a divergent in the intrinsic value or in the price to make an an unusually large profit. So anomalies are able to see, so the people of value are the ones who are able to see through what's efficient and what's not efficient. So these people can separate, okay, these stocks and these sectors are very efficient, these stocks are not efficient. So those are the people, if they have the right set of tools and experiences, they can utilize, even in an efficient market, they can still make an above average return because not everything is always 100% efficient. So the degree to which the market is efficient is always up for debate. And I see it as sort of a sliding scale, that sometimes the market's a lot more efficient, sometimes it's very inefficient. So if you look at the stock bubbles of 2000 and 2007 from the real estate bubble, you see that values get out of control. Sort of like the Toronto real estate. You know, you could buy a house in Long Island for $400,000. The equivalent house in Toronto is $1.5 million. And the dollar to Canadian dollars are close enough to parity. But bubbles exist, and it's so the market efficiency is going to change. Sometimes we have, like I would say, 2012, 2011, the market was very efficient. Today, the market might be a little bit more inefficient as stock prices are rising and PE levels are at higher levels. So some other facts, interesting facts about the market. Approximately 70% of mutual funds outperform, 70% of mutual fund managers underperform their indexes over a 10-year period, and 80% underperform their indexes over a 20-year period. So what I mean by that is, if you're a mutual fund manager that trades large cap stocks, then we compare you to the S&P 500. And over a 10-year period, 70% of these mutual fund managers couldn't beat the S&P 500. And over an 80-year period, over a 20-year period, 80% couldn't beat it. So that would be some proof of some efficiency in the marketplace. If you, over a 5-year period, only 6% of U.S. stock funds achieved a rank in the top half for 5 consecutive 12-month periods. So that means in the first half of the year, they might have been in a top ranking period, but that doesn't always continue. So there's a lot of mutual funds that do very well, and those fund managers may actually be high ranking, but then 6 months later, they're not high ranking. Looking at a year-over-year period. So half the year they're high ranking, doing well. The other half of the year they're underperforming. Over a 301-year period, that's a long time, of mutual funds' existence in the entire period, 139. Okay, so they're saying over a 300-year period. This is directly from the textbook. Of mutual funds' existence, there were, for the entire period, there were 139 mutual funds that were existing for the entire period. Only 20 winners by 2 percentage points or more, meaning that they beat the averages by 2 percentage points or more. Only 20 out of 139 were able to do that over a 300-year period. I find it hard to believe. I question the 300-year period. I don't think mutual funds have been around quite that long, but I don't know what they're basing it on. And the last one is similar to a point made on the previous slide, that performance of mutual funds over a recent 10-year period, you take the 25% of the best performing funds for that 10-year period, then 5 years later, you'll find that of that 25%, only 12% of those top performers were still in the top 25%. So that would mean if there were 200 stocks that constituted the top 25% for the 10-year period, only 24 of those 200 stocks would still be in that top 25% 5 years after that first 10 years. Meaning that it's very difficult for mutual fund managers to consistently outperform the market and be on top. And this is sort of, it's an uninspiring performance, but this is why you don't chase performance in mutual funds. So if you see a mutual fund that's a top performing fund over the past 2 years, typically it's a good bet that they're not going to be a top performing fund next year. And lots of times funds that are underperforming, the following year they're outperforming the market. And sometimes this has to do with sector rotation. So if you have a fund in the oil industry and it did bad this year, it's going to underperform, but next year oil prices move up, that index is going to outperform. So sometimes it's just a reflection of the industries they're involved in, but many times it's just a reflection that, you know, mutual fund managers, they may have a hot streak, but that doesn't last forever. Showing again some inefficiencies. Okay. So the conclusion you can draw by all this, my belief is that markets do have efficiencies within them. However, due to human error, inefficiencies can occur, and if you're somebody who could see a trend before the general population, you could take advantage of it and make some money on it, whether using technical, fundamental, or inside information.